debt made Julian Mercer uncomfortable, not mildly concerned, not cautious, uncomfortable. To him, owing money meant surrendering control over his future. That belief began when he was 16. His father owned a small printing company in Philadelphia. The business survived for years on borrowed money until rising expenses and several missed payments pushed it beyond recovery. Julian remembered creditors calling the house. He remembered unopened envelopes accumulating near the telephone. Most of all, he remembered the afternoon his father locked the printing shop for the final time. From that day forward, Julian associated debt with failure. Years later, he became a commercial airline pilot based in Atlanta. His career was stable, his income was strong, but he still carried several obligations: a modest student loan from flight school, an affordable car loan, and a fixed-rate mortgage on the townhouse he shared with his wife, Elena. None carried an extreme interest rate. Julian treated them as emergencies anyway. Every payday followed the same routine. The mortgage was paid. The regular bills were covered. A small emergency reserve was maintained. Then nearly every remaining dollar went toward debt. Julian made double car payments, added hundreds of dollars to his student loan, sent additional principal to the mortgage whenever overtime increased his income. The balances fell quickly. Each reduction gave him relief. Investing could wait. He had access to a workplace retirement plan, including contributions from his employer, but Julian invested only the smallest amount necessary, sometimes nothing at all. He did not want money entering the market while a lender still had a claim on his income. Whenever Elena suggested contributing more, Julian gave the same answer: "We'll invest properly when we owe nobody." It sounded responsible, disciplined, even admirable. For years, Julian organized his financial life around one destination: zero debt. He kept a spreadsheet tracking every balance. After long flights, he would return home, open his laptop, and update the figures. The student loan became smaller. The car loan nearly disappeared. The mortgage balance declined faster than scheduled. Every number moved in the direction he wanted, but another number remained almost empty: his investment account. Julian did not consider that dangerous. Debt charged interest. Markets were unpredictable. Paying a loan guaranteed progress. Investing offered no guarantee at all. Then, during a flight from Atlanta to San Francisco, severe weather forced Julian and his crew to remain overnight. At dinner, his first officer, Caleb Morgan, mentioned that he had recently increased his retirement contribution. Caleb was younger than Julian and still carried a mortgage. The comment confused him. "You're investing more while you still owe the bank?" Julian asked. Caleb nodded. "My mortgage rate is low. I'm paying it as agreed, but I'm not giving up 20 years of investing to eliminate it early." Julian disliked the answer immediately. Debt was debt. Why tolerate it longer than necessary? Caleb did not argue. He simply asked Julian one question: "What is your employer contributing while you wait?" Julian went quiet. He knew the retirement plan offered matching contributions. He had read the documents. He had simply never calculated how much he was leaving behind. Back in Atlanta, Julian opened his financial records. For the first time, he placed two strategies beside each other. The first was familiar: continue attacking every loan, delay serious investing, then contribute heavily once the balances reach zero. The second was less comfortable: destroy expensive debt immediately, make scheduled payments on the low-interest obligations, collect the full employer contribution, and invest consistently at the same time. Julian expected the first strategy to win. Instead, the comparison exposed what his spreadsheet had never shown. His debts were shrinking, but time was disappearing with them. The employer contributions he had declined could never be collected retroactively. The years of potential compound growth could never be purchased later. Even if he invested much more after becoming debt-free, his money would have fewer years to grow. Julian changed the assumptions repeatedly. He used conservative growth estimates, added market downturns, reduced future returns, accounted for the certainty of interest saved by paying debt early. The answer was not identical under every scenario. If a loan carried an enormous interest rate, paying it rapidly was difficult to challenge. Eliminating a credit card balance charging punishing interest offered a powerful, effectively guaranteed benefit. But Julian did not have that kind of debt. His remaining loans were affordable and relatively inexpensive. He had been treating every obligation as though it were a financial fire. The mathematics unsettled him, but the emotional truth went deeper. Julian was not merely paying debt. He was trying to erase the memory of his father's failure. Every extra payment made him feel farther from the frightened 16-year-old who had watched a family business collapse. The strategy gave him emotional safety. That did not automatically make it the best plan for building wealth. The following evening, Julian sat with Elena at their dining table. For the first time, he explained why debt disturbed him so deeply. He told her about the collection calls, the envelopes, the final afternoon at the printing shop. Elena listened, then reached across the table. "Your father lost control of expensive business debt," she said. "We're making responsible payments on a home we can afford. Those aren't the same situation." That sentence changed the way Julian saw everything. Debt was not one single category. A credit card financing a lifestyle someone could not afford was different from a fixed-rate mortgage supporting a stable home. A predatory loan was different from manageable financing with clear terms. The correct decision depended on the interest rate, repayment conditions, available cash reserves, tax considerations, employer benefits, and the return someone could reasonably pursue elsewhere. Julian did not stop paying his debts. He changed the order of his priorities. He kept a proper emergency fund. He eliminated the remaining high-interest balance immediately. He continued making every required payment on his low-interest loans. But instead of directing every spare dollar toward them, he increased his retirement contributions enough to receive the full employer match. Then he established automatic monthly investments in broadly diversified, low-cost funds. The first month felt wrong. Seeing the mortgage balance decline more slowly made him restless. Part of him wanted to cancel the investment and send the money to the bank. He resisted. The following month, the contributions happened again. Then again, the market rose. Later, it fell. Julian continued investing while his loans continued shrinking. For the first time, two parts of his financial life were improving simultaneously. His debt decreased, his ownership increased. Years passed. The car loan disappeared, the student loan followed. The mortgage continued declining on schedule. Meanwhile, his retirement account grew from his contributions, his employer's contributions, and the returns generated over time. Julian eventually understood that becoming debt-free and building wealth did not always have to occur in separate chapters. Sometimes they could happen together. That did not mean ignoring debt. High-interest debt could consume wealth faster than most investments could reasonably create it. Carrying credit card balances while chasing uncertain market returns was not strategy. It was exposure, but aggressively eliminating every low-interest loan before investing could create another cost: lost time. And time was the one financial resource no future salary could restore. Julian had spent years believing the safest decision was the one that made him feel most relieved. He learned that emotional comfort and mathematical advantage were not always identical. Debt decisions required more than fear. They required comparison. What interest rate was guaranteed? What employer benefits were being surrendered? How strong was the emergency reserve? How long could invested money remain untouched? What level of risk could the person genuinely tolerate? The answer would not be the same for everyone. But the principle remained. Not all debt deserves the same response. Some debt should be attacked immediately. Some can be managed while investing continues. Because paying interest has a cost, but postponing compound growth has one too. No single financial myth destroys a future overnight. The damage accumulates through small decisions repeated for decades. Fear, delay, missed contributions, lost opportunities, assumptions never examined. But knowledge compounds as well. Once Julian understood the difference between expensive debt and manageable debt, he stopped allowing one painful memory to control every financial decision. He still respected risk. He simply stopped treating fear as a strategy. The goal is not merely to owe nothing. It is to build a financial life in which every dollar is given its most valuable job. If you found this story valuable, like the video, subscribe to the channel, and share it with someone you care about. Sometimes building wealth does not require choosing between eliminating debt and investing. It requires understanding which debt deserves urgency and which opportunities become more expensive every year you postpone them.